When it comes to the market, everyone is obsessed with predicting the next big thing, the next crash, the next rally. But what if the real secret isn't in the prediction? What if it's all about preparing for what comes after? That's what we're digging into today. This idea of a massive, quiet transfer of wealth that happens every time the market gets stressed.
So let's start with this question because it really flips the whole thing on its head. Most people, they're just fixated on the drama of the crash itself, right? The big red numbers on the screen. But the real story, the one that truly shapes fortunes for a generation, that unfolds in the quiet aftermath.
And this quote, man, it just nails it. Market meltdowns, they're not really about wealth just vanishing into thin air. Nope, they're about wealth being redistributed. This is the core idea we're going to unpack, this quiet, slow, and totally ruthless wealth transfer.
Okay, so here's our game plan. First, we'll break down exactly what this quiet wealth transfer is. Then, we're going to slice through all the noise in today's, frankly, bizarre and contradictory market. We'll look at history to see a really clear pattern. And then, this is the good part, we'll use all that to build a practical playbook. And finally, we'll talk about why having a solid process always beats trying to make a fragile prediction.
So what is this quiet wealth transfer? Well, think of it like this. It's the systematic flow of assets from one group to another. It goes from the panicked, the over-leveraged, the folks who are forced to sell at the absolute worst time, over to the patient, liquid investors, the ones with cash on the sidelines and the guts to actually use it. This isn't some grand conspiracy. It's just a predictable result of how markets and human emotions work.
All right, let's bring this into the here and now. I mean, if you feel like you have no idea what's going on with the economy right now, you're not alone. You absolutely should be confused. The data is all over the place, sending completely different messages. It makes a simple markets going up or markets going down call pretty much impossible. On one side of the argument, you have this classic flashing warning light. The Shiller-Cape ratio, it's just a fancy way of measuring stock prices against long-term earnings, is way up there, around 38 times. I mean, look at that compared to the historical average. Now, this doesn't mean a crash is coming tomorrow morning, but it's a huge hint that the days of easy double-digit returns are probably over for a while. But then, you flip the coin and you see this. An unemployment rate that's still incredibly low, around 4.3%. Sure, the job market's cooling off a bit from those crazy post-pandemic highs, but it is not falling off a cliff. And that strength, that resilience, is a huge pillar holding up the economy. It's a completely different story than what the valuation chart is telling us.
And the plot thickens, right? Household debt is on the rise, more people are falling behind on payments, consumer confidence is shaky, and we all know office real estate is in a tough spot. But at the same time, the Fed's balance sheet, while smaller, is still gigantic compared to the old days. There's just a ton of liquidity sloshing around. It's this messy mix of real stress right next to surprising strength.
So here's the takeaway. You can build an airtight, compelling argument for a massive downturn, and you can build an equally airtight, compelling argument for continued resilience. You can do both using nothing but the facts. And that right there is exactly why trying to predict what's next is a fool's game. The real play is in preparing, not predicting.
So instead of getting paralyzed by all this confusing data, let's zoom out and look at history. Because while the spark that lights every crisis is different, the fire that follows burns in a remarkably consistent and ruthless pattern. Just look at this timeline: 1929, 2000, 2008. The reason changes: stocks, tech, housing. But the outcome is always the same. Wealth doesn't get destroyed. Not really. It gets transferred. It moves from the levered hands, the people who are buried in debt, to the liquid hands, the ones who have cash, and more importantly, have a plan. This is, without a doubt, the single most important lesson the market will ever teach you.
Okay, so the lesson from history is crystal clear. So what do we do about it? How do we make sure that we're on the right side of that transfer? Well, that's where this playbook comes in. It's a disciplined, rules-based approach that's designed to work no matter what the market throws at you next.
The framework itself is super straightforward. First, you map out the risks you can actually measure, things like high valuations or debt levels. Second, you identify your offsets, the things that protect you, like your savings rate and your cash reserves. And third, you put it all together into a rules-based plan. You decide ahead of time what you're going to do before, during, and after things get crazy.
And that plan, it starts with you. Seriously, before you even think about what stock to buy, you've got to look at your own balance sheet. Your personal financial health is the bedrock of everything. Just remember, Debt forces good people to sell great assets at terrible prices. Cash does the opposite. It gives you options, it gives you courage when everyone else is terrified.
And if you want to see this in action on a massive scale, look no further than Warren Buffett's Berkshire Hathaway. That giant pile of cash isn't sitting there because he's scared. No way. It's a strategic weapon. It's dry powder, waiting patiently for the moment fear goes mainstream and great businesses go on sale. That's using liquidity as an offensive tool.
Now, when we talk about stocks, the playbook is all about flipping the script on that buy what's hot instinct. Instead of chasing momentum, you hunt for durability. You're looking for companies with tons of free cash flow, the power to raise prices, and very little debt. These are the kinds of businesses that don't just survive a downturn, they often come out the other side even stronger.
This same logic applies everywhere else too. In real estate, it means you focus on top-tier locations and properties that serve a real need, not some speculative project that only worked because money was free. And in the bond market, it means you stick to high-quality, short-term debt unless you're a true expert in default cycles. The goal is simple. Don't take big risks until you're getting paid really, really well to take them.
So what about things like gold? The key here is to think of them as long-term portfolio insurance, not a lottery ticket you're hoping to cash in next week. I mean, it's not an accident that central banks around the world have been steadily buying gold for years. They're not trying to time the market, they're strategically diversifying for the long run.
Okay, this all leads us to our final and honestly our most important point. This entire playbook, this whole philosophy, it's built on one simple idea. Focus on your process, not on making predictions. Focus on the few things that are actually within your control.
And that means you have to actively tune out all the noise. Just ignore the crazy headlines, ignore the market gurus predicting the big one for the 10th year in a row. Instead, watch the boring stuff. Watch the measurable data, historical valuations, delinquency rates, credit spreads, refinancing deadlines. Those are the signals that actually tell you something useful.
In fact, think of these 6 things as your dashboard. These are the dials that give you a way more accurate read on the health of the market than any talking head on TV. When these dials start flashing red, that's your signal. It's a sign that risk is being mispriced. And that is when opportunities for a prepared investor start to pop up.
Because at the end of the day, that's the job. Your job isn't to be a psychic and predict the exact week a recession starts. It's to be a planner. It's to make sure your cash, your shopping list of great assets, and your emotional discipline are all ready to go when they're needed most. Because make no mistake, the next quiet wealth transfer is coming. It always does. So the only real question left is, will your playbook be ready for it?
Thanks for tuning in to this breakdown, and of course, just a reminder that this is all for educational purposes and shouldn't be taken as financial advice. Stay prepared, not predictive. We'll see you next time.